growth and welfare. As we all know, that the EGROW Foundation stands for policy-oriented research and research-based policy advice. So it is in that context we bring in the best minds from the world to speak to us, especially on contemporary issues. Today, we have invited Dr. Professor Galina Hale, and today's session will be chaired by Dr. Arvind Virmani. Dr. Arvind Virmani is the chairman of EGROW Foundation. He has been in the past the chief economic advisor of India and also the executive director representing India and other countries at the International Monetary Fund from 2009 to 2012. He is a senior economic advisor in our country. He had worked long years in the Planning Commission, published a number of refereed articles in refereed journals, has books to his credit. With this, I would now invite Dr. Arvind Virmani to please chair over the session.
Thank you, Charan Singh. So let me welcome and introduce Professor Galina Hale. She is a professor of economics at the UC Santa Cruz, and previously she has served as research advisor to the Federal Reserve Bank of San Francisco and an assistant professor in the economics department of Yale University. Her research focus is on international capital flows, stability of financial system, and the nexus between ESG sustainability goals and the financial system. Besides many publications in international journals, she has also co-written a monograph titled Foreign Direct Investment in China. As Charan was mentioning, we are always interested in China. But anyway, that's not the topic of the current talk. Professor Hale is co-editor of the Russian Journal of Central Banking, associate editor of the Journal of International Economics, and a member of the editorial board of the IMF Economic Review and Pacific Economic Review. She is also a director of CIBRA's IFM program and co-director of the UCSC Center for Analytical Finance. With that, let me turn it over to Professor Hale. I don't think I met you or overlapped with you in the IMF, but maybe we'll discuss that some other time. Professor Hale.
Thank you so much for the kind introduction, and thank you, Charan, for the invitation. It's very nice to speak at this venue. I'm sorry it's so late your time. I have to also confess that I've never been to India. I've been to Nepal a number of times, so I very much wish it would have been in person, but hopefully better times in the future. So instead of presenting one paper, I decided I'll give kind of a general, basically summary of what I feel I know about international spillovers and policy coordination. And it is my research area. So I will mention some specific papers that I've written on the related topic. And maybe if you have questions about specific papers, we can talk about them in Q&A. But I thought it would be more useful, especially given the late time in your time zone, to kind of give a big picture than just one specific paper with all the robustness checks and stuff. So I'm sharing my screen. Let me know if you can't see it. Okay. So I titled the talk Economic Spillovers and Contagion. Yeah, it's good? Okay, good.
All right. We can see.
Yeah, good. That was, so I want to start with this chart, which is from our World in Data, and it's drawn from a paper, from a research paper. But that basically is probably familiar to all of you, going back almost 200 years. You look at the total trade, which is all exported goods as a share of GDP globally, right? And obviously you see a lot of, there were periods of globalization in the past, and maybe Barry has talked about that last week. But you see a really rapid increase since World War II. Now, one thing to keep in mind is that this is nominal exports, so like all the exports as a share of GDP, and it's not the value-added measure. So because the global supply chains have been lengthening in the last 20 to 30 years, there is a lot more double counting going on because the share of intermediate goods trade in total trade is increasing. And since it's counting all the exports here, if you did a value-added calculation, the number would be less, but it won't be much less. We would still see a substantial increase in trade to GDP ratio. So countries increasingly rely on international trade and increasingly rely on international trade and intermediate goods for their production as well as their consumption. You also see very rapid increase in international capital flows. This data, well, maybe Barry showed the data that go back longer than that. I should see the book. But the ones I could find goes back to the 70s, and you see an absolute explosion of interest of international capital flows. And this is from an IMF publication, no, from the BIS publication, I'm sorry, where they use external wealth of nations data from Lane and Malesi Ferretti. And you can see that it's mostly debt, but there is also increase in equity as well as the foreign direct investment. In a lot of emerging markets, the foreign direct investment is the portion that's responsible for most of the growth in recent decades. So this is just an increasing interdependence between the countries in terms of their trade and goods and services. The trade and services specifically is increasing, as well as in terms of finance. The other avenues of globalization are a bit harder to measure, but we also see increases in economic migration. So I'm not here including the migration that results from the political, social war events, but the economic migration is also increasing. There is an increasing role in multinational companies, and that is partly captured in FDI data and partly captured in the trade data. But this is a particular aspect that is also becoming more and more important. And as I already mentioned, there is a lengthening of global supply chains. So if you look at the world input-output data, they go back to about 1997. There's some definition changes along the way. But what you find is that at the beginning of that sample, the diameter of the network, so the longest number of steps, if you just look by country industry as they define them, to go from initial sector to the final consumption was about 6. And towards the end of the sample, that longest chain was about 16. So it takes a lot of steps across countries and industries to come up with the final good. And this particular phenomenon also led to this discussion prior to the global financial crisis in 2008. And prior then, we saw the global trade collapse in 2008, 2009. If you remember, there was this discussion of decoupling. People were talking about the Asian trade or Asian economic development is decoupling from the fortunes of the Western world. And it was partly, this idea partly came from the fact that we saw a lot of trade between different Asian countries. And so I never believed in decoupling, and a lot of people I talked to also didn't. The reason I think that confusion came about is because people were not distinguishing between intermediate and final goods. A lot of the increase in trade within Asia was due to trade in intermediate goods that then final goods were shipped to the West anyway. And what we saw in 2008, 2009 with the global trade collapse, in addition to any kind of trade finance channels, which were also in play, the decline in demand for goods, and especially durable goods in the US and Europe, was responsible for a very rapid decline in intermediate goods trade in Asia. And so this whole decoupling idea was, got away pretty quickly. And so we see that now that, the lengthening of supply chain, I will talk a little bit more about this. This is an efficiency thing, but it's also a phenomenon that leads to fragility of the supply chain. And also we see an increase in trade and services. The IMF now has a database with trade and services that is very useful, and it shows that there is an increase. A lot of that is through tourism, but it's also through business services and things like that. So these are harder to measure, so I don't have the charts for them, but these avenues are also increasing. And I'm taking a longer look, so not in the last couple of years necessarily, but that is the trend. So is it good or bad, right? So generally, we think about interconnectedness as being good because we can allocate resources more efficiently across the globe. We allow for specialization in according to the resources and the talents of different specific production locations. There are gains from trade, access to global markets, there's access to global capital. So both the the demand and the supply are now viewed as global, and there is evidence of international risk sharing, right? So I don't need to tell you the details of that. There is a great paper that I really like about 10 years ago, I think, by Peter Henry in Journal of Economic Perspectives that shows for the large sample of emerging and developing economies, that opening financial markets really leads to decline in cost of capital, increase in capital accumulation, increase in investment, and increase in growth. And I think, India could also be an example of how opening the borders has led to a rapid economic development. You tell me if I'm wrong on that. But we also know that interconnectedness then creates the avenues for shocks to spread across countries, right? So I mentioned before, specialization can make supply chains more fragile. And one example of this we observed when there was a earthquake and tsunami that destroyed a nuclear power plant in Fukushima and put that whole area for a while out of commission. There was some specific part of car manufacturing that was produced in a factory near Fukushima. And for a couple of weeks, car manufacturers worldwide could not go forward because they needed this part, and that part was not produced anywhere else, right? So it's an efficient thing to have this extreme specialization, but that efficiency comes at the cost that you don't have redundancies, right? So it's a general trade-off between efficiency and redundancies, right? Like anywhere, it would be very efficient to just have like one economic advisor to the government, but then, it's efficient because you don't have disagreement and you only have to listen to one person, but there is a fragility there because one person can make a mistake, and that's why we create a redundancy in the areas that we really don't want to have fragility. And what's been happening with supply chains, efficiency has been taking precedence over redundancy. And Fukushima showed us that that can actually lead to global repercussions. And, I looked at some papers on this. So it's well documented that this shock did spread across countries. But in the global scale of, total trade and total manufacturing and, asset prices, you actually don't see a big effect. Okay, so even though there was this fragility in one particular supply chain, the macro effects did not really spill over a lot from the Fukushima disaster. So as the global supply chains lengthen and become more specialized, it's also the weight of each supply chain. They become also less granular. Each of them becomes less important. Okay. So that's one example of how trade can spread economic shocks in the ways that we don't have in our traditional textbook models, because in our traditional textbook models, we mostly look at the trade in final goods and not so much trade in intermediate goods. And these models are becoming less and less relevant as the trade in intermediate goods, the share of that becomes more and more important. Financial linkages, we know really well that financial linkages transmit shocks, and policy changes, from 2008, Lehman Brothers. Europe was affected first because European financial institutions held a lot of assets in the US, including in asset-backed securities and including subprime-backed asset-backed securities. And that was the shock that came from the markets, right? But financial linkages also transmit policy changes. And the taper tantrum, let me see if hold on a second. Okay, yeah, I'll talk a little bit more about this. Probably everybody knows, but in taper tantrum was an event when Ben Bernanke gave a testimony in 2013, in May 2013 to the Congress, where he talked about the Fed will start tapering the asset purchases in the market. So it was not an announcement of selling assets. It was not an announcement of stop buying assets. It was an announcement of tapering the pace at which we are buying assets. So we're talking here a second derivative, and the announcement was about doing that in December of 2013. So in fact, I was at the Fed at the time, so I knew that the intention of that announcement was to give assurances to the markets the Fed will continue with its policy of asset purchases for a foreseeable future. But that's not what the markets read from the testimony. The markets pretty much saw the end of the quantitative easing, and 10-year treasury rates went up through the roof. And that also led to a sudden stop in a number of emerging economies as the treasury rates went up. Global investors took the money out of emerging markets, especially, you probably saw that happening in India too. I think Raghu Rajan wrote an op-ed at the Wall Street Journal following this event, discussing that the Fed should be thinking about the emerging economies when it makes decision. And so, Turkey, Brazil, and other countries, especially countries with high debt and negative current account balances, experienced a sudden stop in capital flows that was very, very, very large event for them. And so that just came from, a messaging of the Fed that was not even intentional. That's just the way the markets read it. So the more interconnectedness we have, the more such events will happen and the more events will become global. In case of a Lehman crisis, I have a little economic letter, which is kind of a public interest publication of the San Francisco Fed, where we look at the East Asian countries and we show that the countries that had direct financial exposure to the US experienced much larger economic decline during 2008-2009 crisis than the countries that did not have as much exposure as a share of GDP. So it definitely, the financial linkages play a large role in how much countries are exposed to the shocks coming from overseas. So if you think about which shocks matter, you can think about the origin of the shocks, right? So, and I'm not talking about the current pandemic, which is, I would characterize as a global shock that didn't necessarily originate from any country. We're not going to discuss where the virus came from China, but the economic shock is global in nature. But most shocks don't look like that. Most shocks have some region where they originate, and they can originate from markets or from policies, but basically they're more impactful if they originate in large economies or financial centers. And so what what we've seen so far, and also if there are key links in the global value chain. And I don't know, I'm asked to approve the annotation. Shall I say yes or no?
Try saying yes. Let's see what happens.
Then I have like a thing for writing. I don't want to do that.
Okay.
Okay. All right. So so you see the economies I plotted here, the US, UK, Japan, and China. These are the ones where we see the shocks are originating from. And, the UK is not a large economy, but it's a large financial center. And that's why, the Brexit, for example, has had important spillovers on other economies. On the other side, some economies are more vulnerable to external shocks than others. And the most vulnerable are small open economies. And the way I would define the small open economy vulnerability just in terms of the size is the size of the domestic economy as compared to the economy's reliance on global markets, right? So think about, Singapore or Hong Kong, right? These are, they're small countries, and they're also in the business of being a trade intermediaries. So their total trade to GDP ratio exceeds 100%. And so they're very much reliant on the global markets for trade and finance. But there are other economies as well, in particular economies that are producing, commodity producing economies, think about oil countries, Mexico, Chile, the countries that export their commodities and rely on earnings from that export in order to service their external debt, for example. And obviously, to be vulnerable to external shocks, you can't be a closed economy. So the more open is the trade, the more open is financial account, the more vulnerable the economies are. There is a disagreement in the literature, I think, of whether exchange rate regime can play an insulating role. So, the famous Ellen Ray's Jackson Hole presentation on dilemma, not trilemma, she's basically showing that regardless of the exchange rate regime, global financial shocks spill over to asset prices of the countries, regardless of the exchange rate regime. So her claim is it's not a trilemma, it's a dilemma. Either you have capital controls or you don't. In a more recent paper by Obstfeld and Taylor, they show that actually, if you look at the three types of the exchange rate regimes, hard peg versus free floating versus an intermediate regime, you actually do see some insulation from a hard peg, I think. So the response of the internal economic variables to external shocks, both the capital flows and the asset prices, is smaller if you have a fixed exchange rate regime. If you have an intermediate exchange rate regime, that response is larger. So if you lump those two and oppose them to a free float, then you will get a Lanray's result. But if you separate those two, you actually will get that fixed exchange rate. The fixed exchange rate gives you gives more transmission of the shocks than if you have a free float. So, however, another complication there, and that, I don't have research on this, but I've spoken to central bankers in countries that do inflation targeting. And this is another nominal anchor, just like the exchange rate in a sense, except it's, in the first differences. They find it also difficult to insulate the shocks because the inflation targeting makes really restricts the discretionary monetary policy responses. And so any kind of nominal anchor that restricts monetary policy discretion would limit the buffering effect of the exchange rates. Highly indebted economies and economies with current account deficits tend to be more vulnerable to negative shocks. We usually talk about the adverse shocks because they are subject to the sudden stops and capital flight, and because they are relying on inflow of foreign capital, that of course is very destabilizing for their economies. Also increases cost of borrowing and things like that. So I also find it useful to think about different sources of economic shocks and changes, right? So you can think about external and exogenous shocks, such as the pandemic we currently have, or natural disaster, like in the case of Fukushima, because then it's very clear to see how the shocks transmit. There are also shocks that come from specific markets, like the US subprime mortgage market in 2007. That's when the defaults started. That you can trace everything to the market, and then it also is relatively easy to be able to tell the story of causality of the events. It's harder to work with specific policies, but we know really well that from a large body of research that US monetary policy has a very large effect on global financial markets. Again, a number of papers by Lanray where she introduced the notion of global financial cycle can be shown to be driven by the US monetary policy, and actually can be summarized really well by VIX. I've in a number of papers, I'm looking at this, and the global financial cycle is the variable that's constructed from the vector autoregression analysis that's very highly correlated with VIX. So if you're doing research in this area, it's actually a lot easier. Just put in VIX and it becomes also more transparent what you're doing. So US monetary policy, and I'll talk about it a little more in a second, is one example of a specific policy that's very influential for the rest of the world. But other policies are less discussed in the literature, but also are quite influential. And so you know really well, and I mentioned in the beginning that US-China trade war, that in fact is not over. We still have really high tariffs against China and vice versa. They are affecting other countries. There is a trade diversion that's happening. And China being such a large trade partner of the US, there aren't many countries that can step in. And what a graduate student of mine has been showing in his work, well, he's not my graduate student, I'm one of his advisors, is that Indian trade has been affected at a very detailed level by this growing tariffs on China and US trade. So a lot of economic shocks we discussed, and they're the ones that kind of draw media attention and draw like a flurry of economic papers, are sudden shocks and changes. like the examples I've been giving so far. But I think it's also important to think about gradual changes, because those also spill over. And so some examples that I think are particularly important are, if you think about East Asia in particular, industrialization and deindustrialization of large economies. So we saw, the economic development of East Asian countries, they are following this, rapid industrialization phase. If you think of Japan, was the first country that go through this, and then rapid deindustrialization. And then, Korea picked up the slack, and then there is deindustrialization in Korea. And so that is the process that leads to increased lengthening the supply chains. And it has very large implications on overall global pattern of trade as the countries go through the stages of their economic development. And we've seen that also in China, that there's also an older paper by Xiang Jingwei and Ji Wang that showed that countries go through kind of a pecking order of industries in which they specialize. And as the country develops and the wages increase, it moves up the supply chain. And they predicted that China, about 20 years ago, they predicted that China would be moving along that same path. And sure enough, China is moving along the same path. And with wages rising in China, the whole factories are being shifted over to Vietnam. And Vietnam's economy very much is affected by economic developments in China. And of course, trade liberalization, you have to start thinking about this, all the policies as being endogenous to these forces of economic development, but at the same time affecting those economic developments. If there wouldn't be a demand for trade liberalization because of the lengthening supply chains, maybe there wouldn't be so much pressure on, all those trade rounds that we have. There is, in the last 10 years since the global financial crisis, one particular trend we see is a rapid rise of offshore financial centers. And there are a couple of implications of them. One is kind of methodological for us economists when we are trying to trace down, especially international capital flows at the bilateral way. Those offshore financial centers make it very difficult because, in the past, you just knew whatever goes through Luxembourg and Cayman and Isle of Man, you needed to reassign it to a couple of countries and you were done. Right now, it becomes increasingly more difficult. There is a great website, big project, redrawing the map of global capital flows by, Matteo Maggiore, Brent Newman, Jesse Schreger. They've put together a few translation matrices, but by now that's about, 4 or 5 years old. So things are developing so rapidly that, it's becoming harder to measure capital flows, in fact. But that's, our little niche problem. The bigger problem, of course, is taxes. So for multinational companies locating in offshore financial centers, which are also tax havens, it's becoming harder for countries, including the US, to gather corporate taxes. And that's where, you hear Janet Yellen speaking about the need for some kind of global cooperation, a global minimum corporate tax that would help with the relocation of multinationals to tax havens. And another example of a gradual change is Brexit, right? So there was a sudden event when the vote happened, but all the development since then was pretty gradual, but pretty much going in the same direction. And we have seen substantial relocation of banking resources from the UK to the continental Europe. And, that doesn't have a big global implications, but it does create a diversion of financial flows as the headquarters are being moved to France and Germany. So, and that is not even quite resolved yet. So I think we'll see more changes in there. And then, if you think about those sudden and gradual changes, there is an interaction effect. So one example I could think is, we observe lengthening supply chains, which is a gradual change. But in that context, China's exchange rate policies become more and more important for its neighbors, because RMB is increasingly used as the invoicing currency for intra-Asian trade. And when China decides to peg or unpeg to the dollar or to repeg to a different value, that very much affects monetary policies and inflation rates in the countries that are engaged in heavy trade and intermediate goods with China. So the gradual changes, they make sudden changes more notable. So I want to talk about the transmission channels because it's really kind of the main area of my research, I think, plus 25 years. So things are not simple, right? It's you can still see, I'm getting some messages. Let me know if something changes on your end. So trade in goods and services, there's quite a bit of literature on how trade transmits real shocks, right? Like, again, the Fukushima disaster or any kind of, other natural disaster or productivity shocks. And that's not surprising, right? That's what we have in our textbook models. Then there is a strand of literature using mostly Japanese data, and that, there are papers by Michael Klein going many years ago, and more recently, Weinstein and Amity and Weinstein, that showing that domestic financial shocks in Japan had repercussions for Japanese exports, for example. But what we also learned, and I have a recent paper with Julian DiGiovanni about this, that trade also transmits financial shocks. And if you look at we specifically look at the production linkages using the world input-output data. And what we show that financial shocks, such as US monetary policy shock, transmits to asset prices at the country industry level. And about 60%, or depends on specification, could be 70% of this transmission is due to the production linkages that these countries have with the US consumers effectively. So US monetary shock creates change in the US consumption of final goods, and that trickles down the supply chain to the asset prices of everybody involved in the production of these goods all over the world. Obviously, for the US, the network effect is smaller because there is a bigger direct impact. There is a lot of literature on how financial markets transmit shocks. So I would categorize the research into three groups, looking at quantities like capital flows, and that I include in that bank lending. And I have a paper with Timur Kapan and Camille Aminoyu where we show that when the banks have foreign credit in different countries, if one of the countries to which the banks are lending is experiencing a systemic banking crisis, then those banks experience negative impact on their balance sheets, obviously. That reduces their lending in their domestic countries, but also especially reduces their lending into other foreign countries they lend to that they don't have a systemic banking crisis, right? So the banks could be transmitting lending shocks from one country to another because of their balance sheet impacts. Obviously, we know that financial shocks are transmitted through asset prices because a lot of financial markets, I think a good way to think about that is in the Bruno-Shin framework, where you have those global banks that are actually not even attached to a specific country, which I think is the right way to characterize the global systemically important financial institutions. And they react to things like US monetary policy and any kind of risk aversion shocks. And then they affect their financial counterparts in different regions, and then, or in large countries in each region, such as, say, Turkey is the country in the Middle East that would be an immediate recipient of the shock, that then spreads the shocks to further local levels. And that happens really quickly, right? Because the asset prices react really quickly. And you can put exchange rates into the asset prices, but I think because of a special nature of the exchange rates, exchange rate fluctuations is another sort of transmission. And again, taking Turkey as an example, in the beginning of the COVID pandemic, inability of the Turkish central bank to maintain the value of the currency led to a lot of a snowballing effect and a sudden stop, and created a really difficult situation. So exchange rates do play a special role. How much time do I have? Shall I wrap up so we have Q&A time?
I guess we have 15 minutes.
Okay.
Maximum.
Okay, all right. So I'm going to wrap up really quickly. And then I already mentioned global banks and car manufacturers, so I'll skip. Just to show an example of how US monetary policy spreads to asset prices. And I already talked about all of this. So US monetary policy has a direct effect on advanced and emerging economies. These are little blue lines. But it also has effect on global capital markets and have an even bigger effects on the asset prices around the world. And it also affects global financial cycle, which here I just call the VIX, that affects global capital markets. So the point of this chart is that the mechanisms are actually not very simple. And there are a lot of literature that looks at different types of arrows on this chart, and everybody finds evidence going in both directions. And so that complexity needs to be taken into account. Can vulnerable economies insulate themselves? The answer to this, I think, very quickly is that it's very difficult, right? So the trade barriers are detrimental to growth, as we know, and there are multilateral agreements that are trying to reduce them. Capital controls, there is work by Michael Klein, Jane Shambaugh, and also by Ivan Werning and co-authors that show that capital controls only work if they're extreme, so no capital flows whatsoever. Otherwise, they only change the composition of capital flows, do not really insulate the country against the sudden stops. And extreme capital controls are also detrimental to economic growth. Thinking about what's going to happen in the future, I think, once we get through the pandemic, we are going to see increasing globalization of trade and finance. These are just economic forces that, I don't think individual countries might be an exception, but I don't think the policies can actually stop this. And we'll probably see growth of multinationals and increasing role of offshore centers unless there's some policy efforts to stop that become successful. I want to mention that generally, high impact economies don't internalize their impact on policy making. And, coming from the Fed, I do want to give a shout out for an exception of the Federal Reserve swap lines that were extremely important in 2008, 2009. And again, they were extremely important in the first quarter of last year when the global financial markets pretty much shut down and due to the lockdowns and uncertainty because of the COVID. And Fed even extended, in addition to swap lines, created the facility to purchase the treasuries from emerging markets that needed to exchange them for cash. So there is an exception, but it's exception, not a rule. And some shocks and problems are inherently global. And here, I want to mention climate change as an additional global problem that does not respect national borders. And we have very little in the world policy coordination. We see something, but it's not, I don't think it's enough. And from the emerging market standpoint, it's, they even have less say in that global policy coordination. And trade is the most advanced in terms of coordination. G20 also have monetary policy meetings where they do talk about, non-binding thing. I actually don't know. I've never been to one. I don't know what they're talking about. But presumably they coordinate a little bit. And, global minimum corporate tax, I personally think is a great idea. And, it's becoming less and less of an altruistic idea to be thinking about other countries because the spillbacks are becoming more important. And you can think of one big example is, with the Lehman crisis that created all these problems in Europe that then led in a couple of years to the Euro crisis with Greece's default, that spilled back to the US financial markets. I have a short piece with Fernanda Necchio about this. For every 100 basis points increase in bond spreads in Europe that was due to, say, downgrading of the sovereign ratings, the high yield spreads in the US increased by 75 basis points. So it's a pretty dramatic spillback effect. In addition, what we are facing now is a lot of similar sets of problems in a lot of countries. And some of it is due to long-term trends, and some of that is due to pandemic. We see growing inequality, we see climate change, we see high government debt, and because of increased inequality, we see need for equitable growth and need for sustainable sources of growth. And again, that is kind of interacting with the government fiscal limitations because the changes towards sustainable growth require major infrastructure upgrades that are necessarily falling onto the government to finance. So a lot of similar problems that call for additional policy coordination. I'll stop here.
Okay, thank you. Let me start by putting two questions. Then I'll ask Charan, and we have a brief time, Charan and others. There are two things which you may be able to share. Of course, I was at the IMF after the global financial crisis. So, we heard tons of papers on these issues, and I even wrote a couple of them myself. But contemporary issues, there are two issues which I would really, from your experience, it doesn't have to be a completely academic answer, but whatever you can enlighten us. One is traditionally, we thought of exchange rate as affecting imports and exports, right? The real effective exchange rate or whatever. And now the explanation is that because of the complex financial interlinkages, this is no longer true. So if you can enlighten a little bit us on how that works or what is happening, that's one question. And the second one is you mentioned the effect that your student was doing some research on the trade war on India.
Mhm.
So if you can say a little bit more on that. So these two questions from me, you can answer, and then I'll turn to some of the others if they have some specific questions.
Yeah. Yeah, thank you for those questions. So with the exchange rate, I think what's happening, the countries that float, right, you would normally say, okay, it's an automatic stabilizer, right? It's going to bring my current account back towards the balance every time, through the mechanism you discussed, right, through the terms of trade effects. But increasingly, the countries are inflation targeting, which means that, if there is a negative shock, negative demand shock, right, then I'm going to confuse my demand and supply. What is reducing the outputs, increasing the prices? That's that's a supply shock.
Doesn't matter. Yeah, I get it. So the policies will react, right? Yeah.
Yeah, so the policy react in the opposite direction, right? So you're going to, because you're inflation targeting, you're going to raise your interest rates, you're going to appreciate your currency, you're going to get your current account more negative. So I think that's one way through which it become more complex, for countries, like Korea, for example. Another avenue is through asset prices, right? So if you have a local currency assets, then when the currency depreciates, you might see a bubble in your local currency asset prices, and you might be worried about that. Right. In terms of trade war with India, trade war with China affecting India, what he finds is that in the industries which were subject to larger tariffs by the US on China, you see an increase in exports from India to the US, right? So there is a trade diversion from China to India. And because this tariff war has been lasting a couple of years, that might actually lead to some permanent changes. So, I guess that's good for India.
Yeah, that's very interesting. So if you can, when you meet him next, if you can tell us to tell him to send us a paper, we'd really like to have a look at
Yeah, of course. Yeah.
Okay, thanks. Yeah, that gives an idea. Charan, you want to ask something?
She has made an excellent presentation, but I would go, Professor Ashima Goyal has a question.
Oh, Ashima is there? Yeah.
Yeah, she's there, and Shamda Gopinath, our former deputy governor, is there.
Oh, great. Okay, Ashima, you want to go first, and then deputy governor, madam?
Sure. Thanks, Galina. That was a really comprehensive presentation. But I was just taking the analogy with financial markets. When you want to survive asset volatility, what you do is you have a diversified portfolio. So, like you limit exposure in different areas, you have a balance of things going on, which means that in many variables, you would have middling positions, not extreme. Some of the research you were talking about was saying extreme, fixed exchange rates or either full capital convertibility or zero. I would think that in a situation where you can be subject to a number of shocks, a middling position allows more sort of diversification and gives you shock absorbers against different kinds of shocks. So that was my question.
Yeah, no, you're absolutely right. And I actually have another paper I want to mention with Luciana Juvenal at the IMF, where we show that the balance sheet, so when the dollar appreciated rapidly in the first quarter of last year, we were worried about the balance sheet effects because of the currency mismatch on external balance sheets. And so what our paper is showing that actually emerging markets did not have these balance sheet effects like we saw in the 90s because exactly they've diversified. In particular, they had still foreign currency debt liabilities, but those were offset by external equity positions, which are by definition in home currency. And so in fact, a lot of emerging markets had balance sheet gains because of the dollar appreciation. And that's the standard, Grincha and Bray exorbitant duty part. And so you're absolutely right. You can, instead of having capital controls, you can be diversified. When it doesn't help you is when there are global shocks which move all asset prices up or down, right? So it doesn't matter then where they are. They all go up and down. And then the only way to be insulated is to not have any foreign assets, right? So, which is not an optimal policy. So that's, I think, but yeah, you are absolutely right.
Thank you. Shamila ji? Is she there? Don't see her.
She is there. I don't know if you would like or make an observation, or because she has worked on international currency and things like that.
Yeah.
So if
Dr.
she has a
Gopinath?
question.
I don't.
There's another question by Brijender. Sir, if you would like to.
Yeah, just read it out. I don't think we have time for everybody to say. Yeah.
There's a question by Brijender
Yeah.
that Lehman was collapsed due to interconnectedness of economics. I have doubt on this point that President of US taken decision by giving loan with ease, which create bubble and then finally Lehman collapsed. Now, I do not know. It's, I think, mainly an observation. Would you have some comments on that, Professor Galina?
So I think there were a lot of factors that led to Lehman collapse, but easy credit was one of them. And, that's not the president. There are papers by John Taylor, John Williams, and John Williams was at the Fed at the time, talking about that the US kept interest rates too low for too long after 2001 recession that led to a lot of bubbles in the financial markets. And ultimately, and then there was a housing thing. But yeah, it's a little bit of a longer story than we have time for right now.
Professor, I had one quick question for you. We generally talk of spillovers in the negative sense most of the time. But as you know, we all students of economics also believe in trickle-down theory, and we believe that there can be positive spillovers also. Now, one of the spillovers that you mentioned as an after effect of COVID, Vietnam, Estonia, Bangladesh are suddenly becoming beneficiaries of multinational companies, and some of them are going to be establishing their units there. So it, in a way, gives impetus to their growth. But I haven't seen much literature on positive impulses on spillover. Am I right or am I wrong? The other question I had was, have you quantified the spillover implications in advanced countries versus the emerging countries? For example, when 2008 happened, how did it, we all know it impacted the whole world very severely, but then have we quantified that America's 1% growth hit impacted India by what percentage, or other emerging countries? Of course, depending on, as you mentioned, the transmission, it could be through goods and services, it could be through capital movement. Has any such study been done? Because whenever I teach in the class, this question keeps coming up.
So on the first question, I think there's some work by Asaf Razin looking at the, relocation of production to countries with lower corporate taxes, including your recent papers as well. I mean, he's been working on that for, 50 years. But I haven't seen too much, right? And I think what you mentioned in terms of the, low tax countries, this is a little bit of a zero-sum game, right? So it's just like trade diversion, you have an FDI diversion, if you will. So, from the global perspective, it might improve the distribution across countries, but it's not distribution in the direction where it's the most efficient to produce. It's in the direction where there are least taxes. So if you think in a global sense, that actually allows those rich companies to keep more money to themselves rather than pay taxes. So I don't think it could be a gain for those individual countries for whatever little tax they collect, but not necessarily in like a global welfare sense. On your second question, you can compare GDP growth rates, but I think it's like any growth regressions, it becomes really, really complicated because there's all kind of other things going on if you want to take a longer term perspective. So I think the reason you don't see like a ready-made textbook type papers that you can use to teach is because it's not a simple question to answer. So I have not seen anything like that. If you find something, let me know, because I'd like to be able to teach.
I agree with you. It's very complex. The
Yeah.
last question, if chairman permits me,
Right. Yeah.
Professor Galina, you are one person who's been in policymaking, and now you're wearing an academic hat. So if you don't feel like answering, please don't. But my question was, when the tantrum happened, and you are aware that the markets globally jittered, was the Fed Reserve not aware that this would lead to such a tantrum, or was it just testing the market and sort of a balloon experiment being done?
No, it was, I was there at the time. It was not intentional. As I mentioned, I wasn't at FOMC where they, drafted these things, but, we discussed it on our end at San Francisco, and we knew that was going to happen, that we are going to eventually reduce the pace at which we're buying assets. I mean, it just had to happen because the balance sheet of the Fed was ballooning, and we did not think of that as the contractionary message, right? So there was no testing. In fact, at the debrief after the fact, Janet Yellen was then the head of the San Francisco Fed. So she came back from FOMC, and the discussion we had was, why do we think the markets reacted the way they did? What is that in our messaging that was not, we thought was clear, but apparently was not, to avoid that going forward. So that was a complete surprise to us. And then once the interest rates went up in the US, then we knew that there was a danger of sudden stop, because the interest rates were so low, the long rates were so low for so long, a sudden increase in them, as very much like in the 82, means that large institutional investors withdrew money from risky markets and put them back into the safe assets. So that was predictable.
Thank you. I just want to add, on your point about corporate taxes, I think India is generally in favor of the minimum corporate tax because I think we are affected by the shifting of profits, but we've had a major revenue neutral reform. Many people are not really still aware of it. And it was not a reduction. It was eliminated virtually all, if I remember, every exemption and deduction, and made it into a very simple 25% tax. However, because of our reputation for being very complex and very high tax, we also did a temporary, for a period of, I forget exactly, 3 to 5 years, a signal of 15% tax for new manufacturing companies. So this was in the context of what you said, this trade war between China and USA. The government used this as a signal to show that FDI, that you could now shift, if you want to shift production from China to India, that it would be beneficial. Anyway, so Yeah, it's very good. I think we've had a good discussion. I guess if it was earlier, but I can understand you are in Los Angeles, so it must be pretty early for you. I mean, on the East Coast, West Coast, East Coast. Get confused with now. It's your East Coast. Yeah. So thank you. With that, let me hand it over to Charan to say the last concluding words and make some announcements.
Professor Galina, thank you so much. But there's a lovely question which I thought if you can spend a minute, you're starting the day, if you have time. The question is that what should be the communication policy of a central bank in case a central bank like the Fed got it wrong and they were worried that the communication didn't happen the way you want to. Do you want to spend a minute on that or you want to give it a pass?
I'll probably give it a pass. I do know that the Fed in last 3-4 years has been focusing on major rethinking of the framework, which includes communication, because of the need to unwind the balance sheet eventually, and also because the low R star, which means going forward, the policies, neutral policy definition is going to be different than was in the past, and that affects the messaging a lot. And they did a listening tour where they went to all the districts and talked to all the business people. So there is, I think, the Fed is learning from experiences, and they're more and more talking to the markets, the analysts, to make it a two-way street, so that, and there is a desire to be more transparent. So we are past the Greenspan era where, you know, being murky was a goal. You know? So the being transparent now is more of a goal, because we can see that misinterpretation can lead to undesirable results.
Sure.
So I want to say thank you so much for inviting me, and for everybody who attended, because it's late your time. So thank you so much for staying late, and I really enjoyed the discussion.
Thank you so much, Professor. I have known the professor since 2004, and before she joined the Fed Reserve as their advisor, and I have been tracking her work. She's been on the frontier as far as external sector is concerned. As you have just noticed in her presentation, she has given us, I would say, a complete 360-degree picture on the spillovers. It's been very enlightening for us in India to listen to you, Professor. We would request you to consider coming to us again. Probably you could come and talk to us more on the China-US tariff war and emerging countries, or you could come and tell us more on international currency or internationalization of the currency, because sitting on the sidelines, we can literally see how China is trying to fix its currency and take over as an international currency. And if you have something to share with us, that would really interest us. The final issue that we were thinking in India is the international financial global architecture, and how should it really play out, because China with its two major banks is almost competing neck to neck with the World Bank and IMF there in Washington. And how does the global financial architecture would look in next 15 to 20, 25 years? So if you would have time and interest, we would really be interested in listening to you, because you have been working in these areas, you've been conducting the classes for NBR. So that's why we're making a request. That would be very, very useful for us. So I must thank you, and I must thank the participants and our chairman to sit through the presentation, though it's late in the night. And I should make an announcement. Professor's presentation, which is so good, I'm sure, is classroom should be taught in most of the classes here in India. And this presentation and the recording will be available by noon tomorrow. Next Friday, we have Gautam Chickerman, who's a writer and economist, speaking to us on India 2030. So looking a little more futuristic from the 5-year scenario which we are generally used to. So I would request you to please join us for the session next weekend. This is a book which Gautam Chickerman has written. It's an excellent book. There are various authors who have contributed in the book, and Gautam Chickerman will be talking to us about his vision of India 2030. So requesting all of you to please join us. With this, let me thank once again everyone for joining on this session today, late in the evening. Have a good weekend and see you again soon. Thank you. Good night.
Good night, everybody. Charan, could you send me a link to the video when you post it?
Yes, I will. I'm
Thank
going
you.
to put on the Twitter right away because there were so many takeaways from what you said, and I'm going to put on the Twitter right away. And even when we have the link, we will place it on Twitter, and I'll have my observations there too. We will send you the link.
Okay. Okay. I'll connect. If
On
I'm
our
not
website
connected to
too.
you on Twitter, I will.
Sure. Thank you.
Mhm.